Welcome back. Today we're going to talk about something a lot of people are feeling in the market right now, but very few are actually articulating properly. Bitcoin ETFs are pulling in billions. Institutional adoption is supposedly accelerating. Regulation is clearer than it has ever been. And yet prices feel muted. Volatility feels dead. Altcoins are bleeding. Nothing seems to move the way people expect it to. So the real question today isn't whether crypto is dead. It's whether the market is being quietly throttled. Not crashed, not manipulated in the illegal sense, but controlled, dampened, and slowed in a way that feels unnatural if you've lived through previous cycles. And by the end of this episode, you should have a much clearer idea of whether what we're seeing right now is something to fear, or something to understand and position around. Because markets don't usually go quiet by accident. Let's start with the contradiction that's confusing people the most. Spot Bitcoin ETFs have fundamentally changed the market. You've got consistent inflows from major asset managers. You've got retirement money, advisors, and institutions that previously couldn't touch Bitcoin now buying exposure in size. You've got legitimacy that would have been unthinkable a few years ago. Historically, when you combine new demand with a fixed supply, price reacts aggressively. That's how previous cycles worked. In 2017, retail mania drove price vertically. In 2021, leverage turned every move into chaos. Pumps became blow-offs. Dips became liquidation cascades. But this cycle feels different. Bitcoin holds ranges for weeks at a time. Volatility compresses instead of expanding. Every breakout gets sold into. Every dip gets quietly absorbed. The market just sits there. Meanwhile, altcoins bleed slowly, relentlessly, even on days where Bitcoin looks stable. That disconnect is what's unsettling people. When you zoom out and look at volatility metrics, the picture becomes clearer. Bitcoin volatility is sitting near multi-year lows relative to market interest and capital flows. That's unusual. You don't normally see a market with this much capital moving through it behaving this quietly for this long. That's the first real clue that the structure of the market itself has changed. Because ETFs didn't just bring money into Bitcoin, they brought institutions. And institutions do not behave like retail traders. They don't chase green candles. They don't panic sell red ones. They accumulate slowly, hedge aggressively, and manage exposure across multiple instruments at once. When an institution buys Bitcoin through an ETF, they are not buying because they think it's going up tomorrow. They're buying because they're allocating capital over quarters and years. And that completely changes how price discovery works. In the old market, spot demand translated fairly directly into price movement. If enough people bought, price went up. If fear took over, price collapsed. Simple, emotional, chaotic. Now, for every dollar of spot buying pressure, there is often a corresponding derivatives position on the other side. Futures, options, structured products, all designed to neutralize volatility rather than amplify it. This is where a lot of retail investors misunderstand what's happening. They see ETF inflows and ask why price isn't exploding. But price doesn't explode when demand is absorbed by professionals whose job is to smooth markets, not excite them. Market makers are paid to provide liquidity. Their incentive is not to let price run uncontrollably in either direction. They hedge spot exposure with derivatives. They pin price around levels where options expire. They absorb demand slowly and release supply just as slowly. The result is a market that feels artificially calm, even though enormous forces are acting underneath the surface. This becomes even clearer when you look at derivatives dominance. CME futures now play a central role in Bitcoin price action. Options markets increasingly dictate short-term behavior, especially around expiry dates. If you've noticed Bitcoin drifting back toward the same price levels over and over again, that isn't coincidence. That's max pain. That's where the most options expire worthless. And when enough capital is positioned around those levels, price has a gravitational pull toward them. So yes, you can have genuine demand without explosive movement if someone is being paid to absorb it. Now let's talk about Bitcoin dominance, because this is where the damage is most visible. Bitcoin dominance has been creeping higher, not because Bitcoin is ripping, but because everything else is quietly losing ground. That tells us something important. Capital isn't leaving crypto. It's consolidating. And when capital consolidates, it flows toward perceived safety. For institutions, that safety is Bitcoin, not Ethereum, not Solana, not your favorite altcoin, Bitcoin. Altcoins are suffering for multiple reasons at once. They don't have ETF demand. Many have ongoing token inflation, venture capital unlocks, team allocations, ecosystems that still rely heavily on speculation rather than usage. In a low volatility risk-off environment, institutions simply don't need them. That's why this doesn't feel like a traditional bear market. Bitcoin isn't collapsing. Liquidity isn't disappearing. The market is selective. It's saying yes to Bitcoin exposure and no to broad speculation. And that selectivity is brutal if you're positioned for a fast, retail-driven altcoin season. At this point, people usually ask the big question: is this manipulation? Is the market rigged? Are institutions suppressing price on purpose? The honest answer is no, not in the illegal sense. What you're seeing is market maturation. This is what happens when an asset transitions from a retail playground into a financial instrument. Early crypto rewarded speed, emotion, and risk-taking. This phase rewards patience, capital efficiency, and positioning. It feels unfair if you're used to fireworks, but it isn't broken. It's just grown up. And this is where psychology becomes more important than price. In 2017, the market was driven almost entirely by retail emotion. Fear and greed moved everything. In 2021, leverage amplified those emotions into chaos. What we're in now is neither of those environments. This market is dominated by participants who do not need price to move in order to make money. Market makers earn fees regardless of direction. Institutions hedge exposure. Funds rebalance on schedules, not feelings. So when retail participants look at the chart and say, nothing is happening, what they're really saying is, the market is no longer reacting to their behavior. That's a hard thing to accept. Another critical shift is time horizon. Institutions operate on quarters, not candles. When an ETF desk accumulates Bitcoin, they care about average entry price across months. They want stability, they want shallow pullbacks, they want volatility low enough to satisfy risk models. High volatility is exciting for traders. It's poison for pension funds. That alone tells you where Bitcoin is heading in terms of market identity. It's no longer just a speculative instrument. It's becoming an allocation. And allocations behave very differently from trades. This also explains why narrative-driven pumps keep failing. ETF approval hype. Halving narratives. Political headlines. Each one sparks a short reaction, then price drifts back into range. Not because the narrative is false, but because narrative alone no longer overrides structure. Structure always wins. Another mistake people make is assuming price suppression is bearish. Historically, volatility compression often precedes expansion. The difference this time is that expansion may not look like previous cycles. It may arrive in phases, rotations, controlled breakouts rather than vertical moves. That frustrates people waiting for a single moment where everything suddenly makes sense again. But markets rarely announce those moments. This phase feels especially uncomfortable because information travels faster than ever, but conviction doesn't. Everyone sees the same headlines. Everyone knows about ETF inflows. Everyone hears the bullish arguments. And when price doesn't respond, doubt creeps in. One of the most important lessons from previous cycles is that markets rarely reward consensus expectations. If everyone expects a breakout, it usually doesn't happen. If everyone believes the market is dead, it often isn't. The truth tends to sit where conviction is weakest. Right now, conviction is fractured. Some people believe institutions will suppress price forever. Others expect a sudden parabolic move. Both extremes are likely wrong. The more realistic outcome is continued structure building, followed by selective expansion when conditions align. That may not satisfy people looking for instant validation, but it aligns with how mature markets behave. So where does that leave you as a listener? Not with a prediction, but with a framework. Understand who the dominant players are. Understand their incentives. Understand that your emotional experience of the market is not a reliable indicator of its health. Quiet markets are not dead markets. They are markets in transition. And transitions are uncomfortable by design. Because if markets felt good at turning points, everyone would profit from them. They don't. they feel boring, frustrating, and unfair. That's how participation gets thinned out without dramatic crashes. Slow exits are quieter than panics. And the final point is this: if the market were truly broken, institutions wouldn't be building infrastructure. They wouldn't be launching products. They wouldn't be allocating capital quietly over time. That behavior doesn't signal abandonment. It signals preparation. So if you feel disconnected, frustrated, or confused right now, you're not alone. That feeling is part of the process. The mistake is assuming it means something has gone wrong. Sometimes it just means the market is no longer playing the same game you learned to play before. Drop your thoughts in the comments, hit like, follow. And as always, we will see you at the top.